Welcome back, everyone. Today, we're going to be diving into something pretty intriguing in the world of finance. We're talking about the equity risk premium. You might know it as the ERP. You probably heard this term, thrown around. But it gets to something really crucial: how investors think and feel about risk, and where they see those potential rewards.
It's fascinating how something that sounds technical, like this the ERP, can be like a psychological barometer for how the market's doing. It reveals things like investor sentiment and, their confidence in the future or even their lack of it.
So let's break this down, for everyone listening. The most basic way to explain this is the ERP is the extra return investors expect to get when they decide to put their money in stocks, rather than a safer option, something like U.S. Treasury bonds. It's basically the compensation for taking on more risk.
You can think about it like a risk-reward calculation. So riskier assets like stocks are expected to offer higher returns compared to safer ones like U.S. Treasury bonds, as you just mentioned.
But here's where things get really interesting. Our sources say that right now the ERP is close to zero, meaning investors aren't looking for that much extra return for holding stocks. So this leads to a really important question. What does this near zero ERP mean for you as an investor? And what could be causing this unusual situation?
It definitely makes you wonder about how investors are seeing the current market. Are they being too optimistic? Are they maybe not taking the risk seriously enough? It's something we should definitely look into.
Before we get into all of that, though, let's make sure we all understand what the ERP is and how it's calculated. Our sources say that usually it's figured out by taking the expected earnings yield of the S&P 500 and then subtracting the yield of a 10-year U.S. Treasury note.
For those that don't know, the S&P 500 is an index that tracks 500 of the largest U.S. companies, so it gives us a good overview of the stock market in general. And the 10-year Treasury note is often used as the standard for that risk-free return, mostly because it's backed by the U.S. government, which is usually seen as a very safe borrower.
So if the ERP is getting smaller, does that mean that investors are suddenly seeing stocks as less risky?
Not really. A near-zero ERP could mean a couple of different things. One possibility that our source mentions is that investors just don't see a lot of extra risk in the stock market right now. Maybe because the economic outlook seems positive overall.
It could also be that they're super optimistic about how well stocks will do in the future. They could think companies are going to have some big earnings growth, which would make the risk seem worth it.
When we think about the bigger picture, we have to consider how investors are feeling and the overall sentiment of the market. A near-zero ERP might show us that there's a lot of confidence, maybe even too much. It's important for investors to ask themselves if this confidence is really backed up by how the economy is actually doing.
This brings us to a very important point for you, the listener. How should this near-zero ERP affect your investment decisions? If the extra return you get for holding stocks over bonds is so small, does that make stocks less attractive?
It's definitely a valid thought, but it might not be the whole picture. A near-zero ERP could make you stop and think if the potential reward really justifies the risk. But on the other hand, it could also mean that there's strong expected earnings growth. This could make stocks a good option, even with the smaller premium.
So what does this mean for someone who's trying to decide where to put their money? Should they be moving more towards bonds, or are there other things they should be considering?
This is when a thorough look at your overall investment strategy becomes really important. If you're looking at this near-zero ERP and thinking you need to change how your assets are allocated, it might be a good time to reevaluate your portfolio and see if you need to make some adjustments. This could involve shifting some of your investments into bonds, or maybe exploring some alternative investments, or you could even decide to put more into sectors that you think will do well despite the small premium.
Let's take a look at some of the things that might be contributing to this near-zero ERP. Our sources point out a few key factors. First, we have low interest rates. This can make those typically safe bonds less interesting to investors who are looking for a good return.
When you really think about it, it makes a lot of sense. When yields on bonds are low, the potential return from those safer investments gets smaller. This makes stocks more attractive, even if the extra return is small.
Another thing is a generally good outlook for the economy, with expectations of strong earnings growth for companies. So if investors believe businesses are going to do well, they might be more willing to take a smaller risk premium on stocks.
It really all comes down to expectations about the future. If investors think the economy will be strong and companies will make good profits, they might not be as worried about the near-zero ERP. They might see it as a temporary thing rather than a sign of trouble.
We can't forget about inflation either. When expectations for inflation are low, That can also contribute to a lower ERP. Why? Because inflation reduces the value of future earnings, which makes stocks less appealing when you factor in the risk.
It's really interesting how inflation expectations and interest rates work together. You see, often when inflation is low, central banks tend to keep interest rates low too. And this makes bonds even less attractive and could push investors towards stocks, even though there's a small risk premium.
Our sources also mentioned that high market confidence could be a factor. Some might even call it complacency. If everyone thinks the market will just keep going up, they might not be as worried about getting a big return for the risk they're taking.
This can be tricky for investors. High market confidence can make stock prices go up, but it can also lead to a bubble. And if the mood changes, that bubble could burst. It's really important to be able to tell the difference between real optimism based on strong economic fundamentals and irrational excitement driven by hype and speculation.
Finally, we have to think about how structural changes in the market might be affecting things, like the fact that institutional investors are having a bigger impact. These are the big players like pension funds and endowments. And they often invest for a longer time and have different ideas about risk compared to individual investors.
There's no doubt that the rise of these institutional investors has changed the game. Their size and focus on long-term investing can really influence what happens in the market. And this could be part of why risk premiums are shrinking as they look for returns in a world of low interest rates.
Now let's talk a little bit about the S&P 500, which is like the benchmark for the U.S. stock market. One of our sources says that right now it's trading at 23 times its projected earnings for 2025. That's 40% higher than the average since 2000, which is a big difference.
This shows us that stock valuations are high right now. When you combine that with a near zero ERP, it does make you wonder if the market might be overvalued and if maybe a correction is coming.
Especially when you think about how 10-year Treasury bond yields are around 4.5% at the moment. That makes those bonds a lot more attractive than they were recently.
This gap in yields is creating a situation where investors might start pulling out of stocks and putting their money into bonds instead. They might be looking for a safer place for their money, especially if they think the market might take a downturn. Historically, we've seen this kind of shift happen when the appeal of different types of investments changes a lot.
So thinking long term, what are the implications of all this? Especially if this low ERP sticks around for a while. Could this be a new normal? One where traditional ideas about risk and return don't really apply anymore?
That's a question a lot of market analysts are thinking about. If the ERP stays low for a long time, it could be a sign that investor behavior and the market itself are changing in a fundamental way. It might force us to rethink those traditional models for allocating investments, the ones that rely on historical risk premiums.
You mean investors might have to adjust what they expect to earn in returns, or even take on more risk to get the returns they want? That seems like a big deal.
It definitely has implications for all kinds of investors. Those who don't like taking risks might have to accept smaller returns, and those who are looking for big returns might have to look at riskier investments. The important thing is to find the balance that works for your financial goals and how much risk you're comfortable with.
Before we wrap up this part of our deep dive, one last thing. How should investors use this information about the ERP when they're making decisions? It tells us something about the market for sure, but is it the only thing we should be thinking about?
It's a valuable piece of information, no doubt, but you shouldn't make investment decisions based on the ERP alone. It's important to remember that it's just one piece of the puzzle. You have to consider it in the context of the whole economic landscape. That means paying attention to things like interest rates, inflation, how the economy is expected to grow, and the overall feeling in the market.
It's like a detective novel. We're gathering clues, and the ERP is one of them. But to solve the mystery, we need to put all the pieces together.
And even then, there's no guarantee we'll get the answer right. Markets are complex, and the future is always uncertain. The most important thing is to make informed decisions based on a solid understanding of all the different factors involved.
And that's a wrap for part one of our deep dive into the equity risk premium. We've covered a lot of ground, but there's still more to explore. Stay tuned for part two, where we'll keep unpacking this really interesting concept and what it means for you as an investor.
Picking up where we left off, let's think about how you as an investor can actually use this equity risk premium thing, to help guide your decisions.
Because it's all well and good talking about all this market stuff, but ultimately it's about how we can use it right to make better choices with our own investments.
Definitely. It's about understanding what this means for your own personal portfolio and making sure it's aligned with your financial goals.
So let's say you're looking at this near zero ERP and you're thinking, maybe I should move some of my money into bonds. They seem a bit safer now. Would that be a smart move?
It could be, but like a lot of things in investing, it really depends on your situation. You know how much risk you're comfortable with and all that. If you're getting close to retirement, for example, and your main priority is making sure you don't lose money, shifting more towards bonds might make sense. But if you're younger and you have more time to let your investments grow, you might see this low ERP as a chance to keep your money in stocks, maybe even putting more into them.
Because even though there's a smaller premium, there's still potential for growth in the stock market, especially if those predictions about earnings turn out to be right.
Yeah, that's a good point. And we have to keep in mind that the ERP is based on what's happened in the past. It reflects how the market has performed and how investors felt before. Things could happen in the future, good or bad, that we can't predict just by looking at this one number.
Which brings us back to that important point we made before. Don't make your decisions based on the ERP alone. You have to look at the bigger picture, the whole economic and market situation. Think about interest rates, inflation, how the economy is expected to grow, and even things happening around the world, geopolitical events.
It's kind of like when you're navigating a ship. You need to use lots of different instruments and points of reference to figure out where you're going. It's not just about the compass. You could say the ERP is like your compass, but you also need to check your reps, the weather, the currents, all of that.
I like that analogy.
Yeah.
It really gets across how important it is to take a broad view of investing.
And speaking of taking a broad view, let's go back to something we talked about earlier. Those changes that are happening in the structure of the market, like the fact that institutional investors are having a bigger and bigger influence. And then there's the advancements in technology and the rise of passive investing. All of this is reshaping how markets work and how people see risk.
Do you think it's possible that this near zero ERP is partly because of these changes? Like, could it be more than just a temporary thing? Could it be a sign of what's to come?
That's a question a lot of people who really know the market are trying to figure out. Some believe that we might be entering a new era where those traditional risk premiums are going to be smaller. Partly because of these structural changes we're talking about. It's definitely something to keep an eye on because it could have a big impact on how we think about investing for the long term.
For those of us who aren't experts on the market, it might be a good idea to talk to a financial professional, someone who can help us understand all of this.
Having someone you trust who understands your financial goals and how much risk you're willing to take can be incredibly helpful, especially now when the market seems to be changing so quickly.
I feel like I understand a lot more about this equity risk premium thing now. We've covered a lot. From what it is and how to calculate it, to what's driving it, and what it means for investors like us.
We've dug into why it might be so low right now. Things like optimistic economic forecasts and those structural shifts we talked about. And we've also considered how this near zero ERP could affect how people invest, emphasizing how important it is to look at the whole picture and not just focus on one thing.
But before we move on, I have one more question. If this low ERP is maybe a sign that there's a lot of confidence in the market, maybe even too much, what would happen if that confidence started to go away? What if the mood in the market changed?
That's a really important thing to think about. Let's say something happened that changed how people felt about the market. It could be some unexpected economic data or maybe some geopolitical event. That could cause investors to suddenly start worrying about risk again. And they might start wanting a higher risk premium, which could make stock prices go down.
So it's like everyone is walking a tightrope right now. The market seems to be balanced on this point of high confidence and low risk, but that could change really quick. Is that what you're saying?
You could say that.
Yeah.
And that's why it's so important to stay informed, to keep track of what's happening in the economy and the market, and to be ready to change your strategies if you need to.
The main takeaway here, I think, is that even though the ERP is near zero right now, we can't just relax. We need to stay alert, keep learning, and adapt as things change. Would you agree?
I totally agree. The one thing you can count on in the world of investing is that things are always changing. Being able to adapt to those changes is essential if you want to reach your financial goals in the long run.